All right, so CapitaLand Ascendas REIT, or CLAR as you probably know it, just dropped their full year results for 2025. And if you're an investor, you're probably asking, okay, so what's the bottom line? Well, that's exactly what we're here to do. We're going to cut through all the jargon and really get to the heart of what these numbers mean for you. Okay, before we dive deep, let's just do a super quick refresher on what CLAR actually is. It's a REIT, a real estate investment trust. The easiest way to think about it is like this. It's a giant company that owns and manages a whole bunch of properties that make money, from rent. And when you invest, you're buying a little piece of that portfolio and getting a cut of the rental income. Simple as that. So here's our game plan. We'll start with the big picture for 2025, then we'll get into the nitty-gritty of the numbers. After that, we'll take a peek at the actual portfolio of properties, and we'll wrap up with what's next for them, their outlook and strategy. Sound good? Let's jump in. Okay, first up, the big picture. Let's not waste any time and get right to the question everyone wants an answer to. How did CLAR actually do this year? And this slide, this pretty much tells the whole story of their year in a nutshell. It's a bit of a mixed bag, right? On one hand, revenue went up. That's great. But on the other, the payout that investors like you actually get in your pocket, well, it went down a tiny bit. So what gives? How does that happen? Let's get into the actual figures. So let's look at the top line first. Gross revenue came in at nearly 1.54 billion Singapore dollars. Now that's a 1% increase over last year. It might not sound like a huge jump, but in today's tricky market, any growth is a good sign. It really shows the business is holding steady. But then, here's that other piece of the puzzle, the distribution per unit, or DPU. That's the actual cash you get for each unit you hold, landed at 15.005 cents. And yep, that's a slight dip from where it was last year. Which leads us to the million-dollar question, doesn't it? If the company is making more money, why did the payout for each investor go down? Let's get to the bottom of this. All right, to figure that out, we've got to pop the hood and really break down the numbers to see what's driving everything. The reason for the revenue growth is actually pretty straightforward. It's all about new properties. They went on a bit of a shopping spree, picking up a data center and a business space right here in Singapore, and also a logistics property over in the US. More properties means more tenants, which means, you guessed it, more rental income flowing in. That's what bumped up the total revenue. Okay, so what about that dip in the DPU? This is the crucial part. It's not because they made less money. Nope. It's because there are now more shares or units out there. See, they issued over 202 million new units back in May, probably to raise the cash to buy those new buildings we just talked about. So think of it like this. The profit pie is actually a little bigger, but now they're cutting it into more slices. Each individual slice is just a smidge smaller. For an investor, it's a classic trade-off, right? You get a tiny bit less cash in your pocket today for what's hopefully a much bigger growing company tomorrow. And if we dig a little deeper, you can see that this growth wasn't just coming from one place. I mean, look at this. All three of their main business areas, business, space, and life sciences, industrial and data centers, and logistics, they all saw their revenues go up. That's a really healthy sign. It means the entire portfolio is pulling its weight. So, we've talked about the finances, but what about the actual assets? Let's take a look at the portfolio of buildings that are making all this money. One of the most important things for a REIT is diversification, and you can see CLAR is doing a great job of that here. They've got a nice spread across business space, industrial, data centers, and logistics. It's that classic saying, don't put all your eggs in one basket. If one sector has a tough year, the others can help pick up the slack. That's a smart move for any investor. Okay, let's talk about debt for a second. This number, aggregate leverage, is just a fancy way of saying how much they've borrowed compared to what their properties are worth. Think of it like the mortgage on your house. At 39%, that is a very solid, manageable number. It tells you they're not drowning in debt, which is exactly what you want to see. And this number here, the interest coverage ratio, or ICR, is directly related. It basically asks, can they easily afford the interest payments on that debt? And the answer is a big yes. A ratio of 3.6 times means they're earning enough to pay their interest bill more than 3.5 times over. That is a super strong sign of financial health. No worries there. Okay, so we've covered what happened in 2025 and why. But as investors, we're always looking ahead, right? So where is CLR headed from here? And it's a classic two-sided coin. On the opportunity side, they're not just sitting back. They're planning to keep buying smart properties, upgrading the ones they already have, and really beefing up their logistics arm, but they're also realistic. They know there are risks out there, the global economy's a bit shaky, and you've always got things like tariffs and political tensions that can stir the pot. And this quote from the CEO, William Tai, I think it says it all perfectly. Selective and proactive while maintaining a strong balance sheet. In other words, they're still on the hunt for growth, but they're not going to be reckless. They're going to be smart about it and make sure they don't jeopardize the healthy financial position they're in. It's a message of cautious optimism. So let's boil this all down. What are the key things to take away from this? First, the company had a solid year. Revenue went up because they bought some great new properties. Second, don't be spooked by that small dip in the payout. It wasn't because of bad performance. It was a strategic move to fund future growth. And third, their finances look really healthy, and they have a sensible, steady-as-she-goes plan for the future. This content is intended to serve strictly and only as an informational, independent, objective summary of recent events, and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.